For most of the 20th century, the American retirement dream had a sound. It was the sound of a mortgage burning. Families would gather in the backyard, set the paid-off loan on fire, and celebrate. The house was finally theirs, free and clear. That party has mostly disappeared. Today, more than 4 in 10 homeowners between 65 and 79 still owe money on their house, and a growing number carry that debt deep into their 80s on a fixed income in a system that was never really built to help them pay it off. For a long time, the plan was simple. You bought a house in your 30s, paid it down over 30 years, and walked into retirement owning it outright. Back then, a lot of workers also had a pension, a guaranteed monthly check from an employer that lasted the rest of their life. The house was paid off, the pension came in, and Social Security topped it up. That was the three-legged stool. So what changed? A few things all at once. Pensions mostly disappeared, replaced by savings plans like the 401k, where you fund your own retirement out of each paycheck and hope the math works out. Home prices climbed faster than incomes, so people bought later in life and borrowed more to do it. And starting in the 2000s, refinancing exploded. Millions of homeowners refinanced again and again, often pulling cash out of the house to cover other bills, each time resetting the loan back to a fresh 30 years. The tax code helped too, quietly rewarding mortgage debt by letting people deduct the interest, which made borrowing against a home feel almost responsible. Add in second marriages, later home purchases, and the simple habit of treating home equity like a savings account you can tap, and you get a country where owning your home outright by retirement is no longer the norm. The house stopped being the thing you finished paying for before you stopped working. For a lot of people, it became the thing you were still paying for long after the paychecks ended. Let's start with the debt itself. Over the last 30-odd years, the share of homeowners aged 65 to 79 still carrying a mortgage jumped from about 24% to 41%, and the amount they owe has exploded. The typical mortgage balance for that group rose more than 400%, from around $21,000 to $110,000 adjusted for inflation. Among homeowners 80 and older, the change is even sharper. A generation ago, almost none of them had a mortgage. Now nearly a third do. And it's not just housing debt. Total debt for households headed by people aged 65 to 74 has more than quadrupled over the last few decades, and for those 75 and up, it has risen roughly sevenfold. Keep in mind, older Americans still have the highest homeownership rate of any age group, with about 4 in 5 owning their home. So this isn't a story about people who never made it. It's about owners, the ones who supposedly did everything right, still holding a loan. Now put that next to retirement income. The average Social Security retirement check is a little over $2,000 a month, roughly $25,000 a year. And that's the average. The median, the amount right in the middle, is closer to $1,750 a month. A mortgage payment can swallow a huge chunk of that before a single other bill gets paid. In higher-cost states, the payment alone can eat the entire check. Here's the part people miss. Even if you do own your home free and clear, it is not free. Property taxes keep climbing. In recent years, the typical property tax bill pushed past $4,000, and it rises with your home's value whether or not your income does. Homeowners insurance has gotten worse, with the average premium climbing past $1,700 a year, up more than 60% in just 5 years in many markets, and far more than that in places hit by wildfires and storms. Then there's maintenance, a new roof, a failing furnace, the water heater that dies in February. None of that stops when the mortgage ends. So the real cost of housing in retirement isn't one number, it's a stack. And for the roughly 1 in 4 homeowners now spending more than 30% of their income on housing, a group that increasingly skews older, that stack is the difference between comfortable and squeezed. So who's on the other side of all this debt? Follow the money, and it runs through a long chain of businesses that each take a cut. It starts with the lender who writes the loan, but the lender rarely keeps it. Most mortgages get bundled together and sold to investors as bonds. A separate company, the servicer, then collects your monthly payment for a fee and passes it along. You may never meet any of them, and if your loan gets sold, the name on the bill can change more than once. Here's the quiet part. A 30-year mortgage is front-loaded with interest. In the early years, most of your payment covers interest, not the balance you actually owe. So every time an older homeowner refinances and resets the clock back to 30 years, they slide back to the start of that curve, paying interest all over again. Refinancing can lower a monthly payment, which feels like relief. But stretched across a longer timeline, it often means paying far more in total. That's not a scam. It's just how the product is built, and the incentive to sell you a new loan is always there. The same goes for the home equity line of credit, a second loan against the house that lenders market hard to older owners sitting on years of built-up value. During the boom years, the cash-out refinance turned the family home into something close to an ATM, and every dollar pulled out came with a fresh loan attached. There's real money in servicing these loans, too. The right to collect on a pool of mortgages is itself an asset that gets bought and sold, and investment firms pay for it precisely because that steady stream of monthly payments and the fees layered on top is reliable income. Then there's the reverse mortgage industry aimed squarely at homeowners with equity. A reverse mortgage, most commonly a federally insured product called a home equity conversion mortgage, lets someone 62 or older borrow against the house without making monthly payments. The balance grows over time and gets repaid when the owner sells, moves out, or dies. For the companies that originate these loans, the money comes from upfront fees, interest that compounds quietly in the background, and insurance premiums backed by the federal government. Around 1.5 million of these loans have been made since 1990, and the average borrower is in their mid-70s. The whole model runs on one simple fact. Older Americans are sitting on an enormous pile of home equity, nearly $15 trillion of it, and a lot of industries would very much like to help you spend it. Now for the question that matters most, when you retire still owing on your home, who actually pays? Mostly you do. And here's a hard truth that catches people off guard. The safety net does not cover this. Medicare, the federal health insurance program for people 65 and older, pays nothing toward your mortgage. Medicaid, the joint federal and state program for people with very low income and assets, doesn't pay your housing debt either. Those programs are built for medical care, not the roof over your head. So the mortgage comes out of the same fixed income you're using for everything else. Social Security, whatever you saved. Money pulled from accounts like an IRA, an individual retirement account, drawn down faster than planned to keep the payment current. And for many older homeowners, the house is not just one asset among many, it's the only real one they have. When the income isn't enough, the options narrow fast. Some retirees lean on adult children, quietly turning a housing problem into a family one, with grown kids covering a parent's payment while trying to fund their own retirement. Some tap the house itself through a reverse mortgage or a home equity line, trading tomorrow's equity for today's bills. And here's a warning sign the industry itself has noticed. More than 1 in 5 people now seeking a reverse mortgage are already running a monthly deficit, spending more than they take in. That's up from about 1 in 8 just a year earlier. These aren't people making a clever financial move. They're people trying to stay afloat. And when the money finally runs out, the wealth built over an entire lifetime, the equity in that house, gets consumed one payment at a time until there's little left to pass on. What looked like a nest egg on paper slowly turns back into someone else's income. And if the payments simply can't be made, the end of the road is foreclosure, losing the home in the years when moving is hardest and starting over is nearly impossible. Even a reverse mortgage, which promises no monthly payment, a CSINT, carries a trap door. You still have to keep up the property taxes and insurance. Fall behind on those, and the loan can be called due, and the house can still be lost. The monthly payment is the cost you can see. The expensive ones hide behind it. Start with interest. A mortgage carried into your 70s can mean tens of thousands of dollars in interest paid during years when your income has stopped growing. Then there's what the debt crowds out. Research on older homeowners found that when a mortgage finally gets paid off, spending on healthcare goes up. In other words, while the mortgage is still there, some people are quietly spending less on their own health to make the payment. That's a cost that never shows up on a statement. Reverse mortgages have their own hidden meter. Because the balance compounds instead of shrinking, it grows silently year after year, steadily eating the equity that might otherwise have passed to children or paid for a move into assisted living later on. The heirs often don't learn how little is left until the estate is settled. Refinancing hides a cost too. It feels like a win because the monthly number drops, but resetting a loan can quietly add years and thousands in interest to a house you meant to own by now. There's also deferred maintenance, the repairs people put off because the mortgage ate the money until a small problem becomes an expensive one. Rising insurance has its own trap. As premiums jump, some older owners raise their deductible or drop coverage they can no longer afford, quietly taking on risk that could wipe them out after a single storm. And when the numbers finally stop working, selling the home under pressure is its own hidden cost. A forced sale rarely happens at the right time or the right price, and there's the emotional weight translated into dollars. The stress of a payment you're not sure you can make, the choice between fixing the car and paying the bank, the pressure that lands on adult children who step in to help. None of it appears on the loan documents. All of it is real, and all of it is part of the true price of retiring with a mortgage. Step back, and the logic gets clearer, if not comforting. Almost every incentive in this system points toward more debt for longer. Lenders and servicers earn more from big, long loans than from small, short ones. Government policy has spent decades encouraging people to buy homes and even rewarding mortgage debt through the tax code, while offering very little to the person still carrying that debt at 75. And Social Security, the one piece of income most retirees can count on, is designed to rise slowly with inflation, while property taxes, insurance, and repairs often rise faster. Now, this is where honesty matters. Retiring with a mortgage is not automatically a mistake. If you locked in a low fixed rate, keeping that cheap loan and leaving your money invested can be a perfectly sound choice. And plenty of people who could pay off their house choose not to on purpose and do just fine. The problem isn't the debt itself. It's the difference between the people who chose it from a position of strength and the far larger group who ended up there because home prices, stagnant wages, and a medical bill or two left them no other path. Other wealthy countries lean less on the paid-off house as a retirement plan, partly because they offer stronger public pensions, but they make their own trade-offs in higher taxes. And the demographics point one direction. As the baby boomers age and live longer, more people will carry housing debt further into life than any generation before them. So what does retiring with a mortgage really deliver? For some, it's a smart use of cheap money and nothing to fear. For many others, it's a monthly wait that turns a fixed income into a tightrope. The house was supposed to be the finish line, the one big thing you owned outright when the paycheck stopped. Increasingly, it's just another bill, one that follows you into your 80s and doesn't care that the paycheck stopped. The banks and servicers still get paid. The reverse mortgage industry stands ready to turn your walls back into cash, and you, the homeowner, are left doing the math every month, weighing what the roof over your head is worth against everything else you need. Owning a home was always sold as security, but security you're still making payments on isn't quite the same thing. In America, the house may hold your wealth, it just doesn't always let you keep it. If this breakdown helped you see where the money really goes, take a second to like the video and subscribe. It's a simple way to support clear, honest looks at the economics of getting older in America.